Hi, I'm Andrew Kerai, CFA instructor here at UWorld. And today we're going to be doing a deep dive on the CFA topic of deferred tax assets versus deferred tax liabilities. These deep dive videos are intended to address specific topics that are likely to be tested on exam day and ones that we've seen candidates struggle with in the past. So here we're going to look at a question that candidates have missed on the exam in the past. This is sort of a high-level question on deferred tax assets and deferred tax liabilities. There are, of course, a number of ways a question like this could be asked. So we're going to take a dive into this topic and some areas where candidates get tripped up, as well as address some of the key concepts between both deferred tax assets and liabilities that could be addressed in various forms through questions on the exam. So now we're going to look at, when does a temporary difference create a deferred tax liability versus a deferred tax asset, and how do valuation allowances affect deferred tax assets? So before we dive into that specific question, we're going to briefly address why this is a key area within the financial reporting and analysis section of the exam that has the potential to trip candidates up. So first and foremost, the financial reporting and analysis part of the CFA curriculum is a key part of the exam's weighting. It's just under 20%. The estimates are about 13 to 17% in terms of the weighting level on the exam day. The estimated error rate in this particular section for candidates is about 50%. So the CFA hasn't historically published the exact passing score percentage, but as a general rule of thumb, you should strive for a number above 70% to ensure that you pass on the exam. So at a level of 50%, clearly this has been a relatively challenging area for many candidates, and an area that has the potential to trip up some candidates due to the specifics of a certain topic. In this case, deferred tax assets and liabilities, the differences between the two, how they arise, certainly a number of questions on the exam day that could address these topics that can be relatively tricky. So some of the common pitfalls for candidates are confusing the idea of temporary differences versus permanent differences. Key thing to remember here, that deferred tax assets and liabilities arise only from temporary differences that are likely to reverse in the future. So as an example, if there was a difference between taxable income and accounting income that was viewed as permanent, let's say, for example, that it was viewed that the particular company would never be profitable, never be able to utilize a loss carry forward, for example, that would be a permanent difference, and there would be no corresponding deferred tax asset because that loss carry forward would not be used in the future. The entire purpose of creating a deferred tax asset or liability is recognizing either a future asset, meaning less taxes that are going to be paid in the future, or a deferred tax liability, more taxes to be paid in the future that arise simply due to a temporary difference between accounting and tax treatment. There's also the idea of misclassifying DTAs versus DTLs. So as a candidate, make sure to think through whether it is an asset, meaning a future benefit through lower taxes paid going forward, or a liability, the expectation to pay more in taxes going forward than would be implied through the accounting financial statements. The edge of mastering this topic, and this could be said for a number of areas in the curriculum and within the financial reporting and analysis section, but there's clearly a number of different ways these topics can be addressed. As a rule of thumb, the CFA curriculum is not a formulaic memorization exam. It is an application exam. What I mean by that is that what the curriculum really wants to test is your ability as an analyst or a portfolio manager to be able to apply these techniques when thinking about security valuation and portfolio management. So being able, for example, to look at a financial ratio or adjust a financial ratio based on the creation of a deferred tax asset or liability and the implications on the financial health and prospects for a particular company. So we're now going to look at a review of some of the key topics associated with deferred tax assets and liabilities, including some of the definitions, and then work our way through an example to look at some of the areas that could be tested on the exam. So first and foremost, a deferred tax liability is created when taxable income is less than accounting income. So the idea here is that at some point in the future, the company will be paying more in taxes. That is a liability that's recorded on its balance sheet. A deferred tax asset is the opposite. The company has effectively prepaid taxes. Taxable income should be lower at some point going forward. That is a deferred tax asset for the business. And the value of that deferred tax asset or liability is the amount of that temporary difference times the tax rate. So, for example, if a company used an accelerated depreciation method and recorded an extra $1 million of depreciation expense under tax versus GAAP, they would create a $1 million times a 21% corporate rate, if that's the applicable corporate rate for the company, which would be a $210,000, in this case, deferred tax liability, because they've recorded a higher level of depreciation expense, meaning lower taxable income versus under GAAP in this example. Steps in order to perform the calculation for a deferred tax asset or liability. First is to look at the tax base of either the liability or the asset. As an example, if that company had depreciated at a higher level under tax versus GAAP in the early years of that asset's useful life, the tax base or the tax carrying value would be less given higher depreciation expense. They would then create a deferred tax liability going forward. The key here again is to analyze whether this difference is temporary or permanent in nature. Deferred tax assets or liabilities only arise due to temporary differences between GAAP accounting or financial reporting and tax accounting. A key way to remember this is in the name deferred implies that will be realized at some point in the future. So if that realization will not occur, the difference would be permanent in nature and no deferred tax liability or deferred tax asset would be created in that scenario because there'd be no reversal and realization of that tax true-up, if you will, in the future. The other area where candidates can get tripped up is the direction of either a deferred tax asset or liability. The key thing to remember here on exam day is thinking through whether the company is expected to pay more or less taxes in the future, assuming that difference is temporary. And if they're expected to pay more in the future, that of course would be a liability. If it's less in the future, that would be a deferred tax asset. And then to record the value of that DTA or DTL, you simply take that temporary difference, multiply it by the company's tax rate, and that is the amount that's recorded on the balance sheet. And lastly, analyzing whether or not a valuation allowance is necessary for deferred tax assets. A valuation allowance needs to be recorded if it's reasonable that a company would not realize all or some of the deferred tax asset they have on balance sheet. So, for example, if a company has a large deferred tax asset, but they believe their profitability will not be sufficient to deduct the full amount in future years, they would then need to record a valuation allowance to reduce the value of that asset on the balance sheet. We'll dive in a little deeper here to some of the key definitions here to make sure we have a clear grasp of the topics in this part of the curriculum, and then we'll go into an example. So again, a deferred tax asset represents a future tax benefit. that's the key here. It's a future tax benefit that arises due to timing differences between GAAP financial reporting and taxable reporting. So in this case, there's an expectation of a reduction in future income tax payments that the company expects to realize in future years. The way I think of this is a prepaid tax. In this scenario, a company has paid more in taxes in the current year, and that effect is expected to reverse itself going forward in the future, which is an asset and a benefit to the company today. So the example we use is a bank estimates, for example, $10 million of future loan losses or bad debt expense that are recorded as an expense under GAAP. So banks and other lenders are required under US GAAP to record a provision or allowance for loan losses based on the expected losses on the loans that they've originated before those losses actually occur. So in effect, what's happening is that the company is going to record a lower amount of GAAP income than taxable income. Under tax accounting, the bank is only allowed to deduct loan losses as they actually occur. So in this example, the bank takes a provision for loan losses of $10 million on day one. The losses have not happened yet, so GAAP income is $10 million lower than taxable income. That $10 million difference is temporary in nature because in this example, the bank expects those losses to occur in the future. Assuming a 21% corporate tax rate, the company would record, in this scenario, a deferred tax asset of $2.1 million. And again, the key point here is, why is it a deferred tax asset? Well, these loan losses have not happened yet. The company has taken a provision for loan losses is required under US GAAP. Those losses are expected to occur at some point in the future, and the company expects to be able to utilize the full benefit from this deferred tax asset in the future. So when thinking about whether or not the bank will need to record a valuation allowance against this deferred tax asset, the bank is required to regularly assess whether or not they expect to fully utilize this DTA going forward. If the bank, for example, believes they will not have sufficient profitability, or if they expect that actual losses will be less than what they've recorded under US GAAP, they would reduce the valuation of the deferred tax asset. In this scenario, there'd be other accounting elements that come into play. For example, under US GAAP, they would record a negative provision, for example, if loan losses were expected to be lower than they had estimated. But for the purpose of the DTA, the key point is if they believe that that deferred tax asset will not be either partially or fully utilized going forward, they'll need to reduce the value of that deferred tax asset on their balance sheet. A deferred tax liability is, again, the opposite. It represents a future tax obligation, a future increase in income tax payments that arise from temporary differences. So while a deferred tax asset is effectively a prepaid tax, a deferred tax liability is effectively a deferred tax that is expected to be paid in future years. That's carried as a liability on the company's balance sheet. So in this example, we look at a manufacturer that uses accelerated depreciation for its machinery for tax purposes, but straight line under GAAP. As a result, the company would be recording a higher amount of depreciation expense and recording lower taxable income versus US GAAP. In this scenario, that difference would be $250,000 of depreciation for income tax purposes, only $150,000 for its financial statements. So the $100,000 difference, and again, this is a temporary difference between the accounting and taxable income. This would be a deferred tax liability because taxable income is lower in the current year. Therefore, income taxes paid are lower in the current year versus income tax expense under GAAP accounting. that's expected to true up in the future, meaning a higher level of income tax payments going forward. The amount of the deferred tax liability the company would record in this scenario would be that $100,000 difference times the 21% corporate rate, if that is the corporate rate for this business. Therefore, they would record a deferred tax liability of $21,000. As the difference in depreciation methods reverses, meaning the company eventually has fully depreciated this asset under tax purposes but not GAAP, that effect will reverse. Taxable income in future years will eventually be higher than GAAP income. They will pay more in taxes, and that deferred tax liability will get reduced going forward as the difference in the tax expense recorded under GAAP and tax as that gap closes. So key things to remember: if it's a deferred tax asset, it's effectively prepaid income tax payments that reverses going forward, and that deferred tax asset is used up over time. Deferred tax liability, it's a deferred tax. In effect, income tax payments will likely be higher going forward, and that deferred tax liability will reduce over time as that difference is trued up. The CFA exam really likes to hone in on the implications of these topics for financial statement analysis and portfolio management. So as candidates, you should pay special attention to how do DTAs and DTLs impact the assessment of a company's financial health and its future prospects. So one thing to keep in mind for deferred tax assets is what's the likelihood that these future tax benefits are going to be realized. And one way to do that is to look at the footnotes for any valuation allowances and how they're calculated. As an example, if there's a particularly large and growing valuation allowance that is tied to a deferred tax asset, that could suggest either there are reasons why that deferred tax asset would not be fully utilized that are specific to that deferred tax asset. For example, if there was pending legislation that would change the way companies could record depreciation for tax reporting purposes or GAAP or both, that could be a specific reason why there's a valuation allowance that is tied to that deferred tax asset. However, it could also signal that the company is skeptical regarding whether they'll have sufficient profits to utilize that deferred tax asset going forward. So that could potentially be a red flag if that is the case regarding the future financial prospects for a business. The analyst should also consider the impact of deferred tax liabilities in the company's leverage profile. So it's often the case that an analyst will include a deferred tax liability with other forms of debt on the company's balance sheet when looking at things like interest coverage or financial leverage when comparing companies across the same industry. So when you're comparing firms that are either across the same industry or in the same market, an analyst will often need to factor in deferred tax assets and liabilities when they're performing in a financial ratio analysis between each of these companies. For a deferred tax liability, that would be a negative from the standpoint of higher leverage and lower interest coverage, and a liquidity negative for the business, given that it's expected a higher level of cash going forward will be needed to make income tax payments. For a deferred tax asset, that would be a benefit, of course, for a company, given that they'll be recording a lower amount of income tax payments as that DTA is utilized going forward. But the analyst needs to be careful to ensure that it's reasonably likely that that deferred tax asset will be utilized going forward, and carefully read in the footnotes for any red flags regarding either the potential utilization of that deferred tax asset or any implications for a company's future profitability through an unusually large or growing valuation allowance. Here we have a question that addresses whether the value of a deferred tax asset will likely increase if income tax rates increase, if a valuation allowance is increased, or be created when the carrying value of the asset under GAAP on the financial statements is higher than the tax base. So we'll take this one by one. Will a DTA increase when income tax rates increase? Well, as you'll recall, the formula for estimating a deferred tax asset is looking at the future at the temporary difference between taxable reporting and GAAP reporting for the financial statements, and then multiplying that by the tax rate. So if we have a deferred tax asset and tax rates increase, that would increase the value of the deferred tax asset. Let's take a look at B. Well, if we increase the valuation allowance, that would reduce the deferred tax asset. So that would be the opposite effect. As the valuation allowance increases, that suggests it's increasingly likely that all or a part of that deferred tax asset will not be realized. That would be a negative and reduce the deferred tax asset. If the carrying value of an asset under GAAP is higher than the tax base, that means that it's been written lower for tax purposes. That would then be a deferred tax liability, not a deferred tax asset. So in this case, the one that would result in a higher deferred tax asset would be higher income tax rates, because the value of that benefit is greater, because the company can directly reduce their future income tax payments by a greater amount. The next question looks at when deferred tax liabilities arise and are created. Well, the first consideration is if the tax base of an asset exceeds its carrying amount. Then we look at whether the carrying amount of a liability exceeds its tax base, or if the tax base of a liability exceeds its carrying amount. Well, if we have the carrying amount of a liability that exceeds its tax base, then this particular liability has been reduced by a greater extent under tax purposes versus U.S. GAAP. But what we're really looking for here is when the tax base of a liability exceeds its carrying amount, because in this scenario, we would expect the company to incur a higher level of future taxable income. So the key thing to remember here is a deferred tax liability occurs when the carrying amount of the asset exceeds its tax base, and as we saw in the previous question, or when the opposite is true, when the carrying amount of a liability is less than its tax base. Now we look at a company that's recognized a valuation allowance against a meaningful part of its deferred tax assets. If the company believes that its future profitability is likely to rise, well, in this case, it's reasonably likely that it will be able to utilize a greater portion of its deferred tax asset. If concerns about profitability were driving the valuation allowance to begin with, if that reverses, this would likely increase the value of the deferred tax asset. In this case, we're looking at the value of the DTA, not any deferred tax liabilities. So the most appropriate answer would be B, that if the company's future profitability is set to rise, it would likely reduce its valuation allowance or possibly eliminate it altogether, depending on the magnitude of the higher profit expectations. So the correct answer in this scenario would be an increase in the value of its deferred tax asset. Here we'll look at some of the key takeaways that we addressed in this deep dive. So some top rules. As a rule of thumb, a deferred tax liability is a deferred tax. Taxes will be paid later. Deferred tax asset is a prepaid tax. Taxes are paid early. Temporary differences are the driver of deferred tax assets and deferred tax liabilities. And again, this is temporary differences between taxable income and income recorded for financial reporting purposes under GAAP in the U.S. Permanent differences, there is no deferred tax asset or liability created. If a valuation allowance is created against a deferred tax asset, that suggests that a portion or potentially all of the deferred tax asset will not be utilized or is likely not to be utilized. So it is a practical matter, and we address some of this in the financial analysis section of this presentation. But financial analysts use deferred tax assets and deferred tax liabilities to both estimate the financial health, including the capital position and the leverage profile of a business and its future prospects. For deferred tax assets, they will be a cash flow positive going forward, assuming they can be utilized. Deferred tax liabilities increase the leverage profile of a company and are a negative from a liquidity and cash flow standpoint going forward. Loss carry forwards create deferred tax assets, and analysts should be careful to ensure that the firm has enough profitability and is able to utilize the deferred tax assets going forward. The analyst should be aware of any potential tax policy changes, which would include a change in income tax rates for companies, which could have implications for the value of deferred tax assets and liabilities. If income tax rates are expected to increase, that increases the value of both deferred tax assets and deferred tax liabilities, because that temporary difference is multiplied by a higher factor, which magnifies the impact on future income tax payments. And from a comparison standpoint, analysts should be careful to include the impact of DTAs or DTLs in financial ratio analysis when comparing companies in the same sector, for example. And that wraps up the deferred tax analysis and deferred tax liabilities deep dive presentation, part of the CFA Financial Reporting and Analysis curriculum. I'm Andrew Kerai, CFA instructor at UWorld. We'll look forward to seeing you next time.